We wanted to expand a little bit more on James's question. Is there a proper delta to buy a call? In that last webinar, we did discuss the delta on expectation of an underlying stock movement, which ones we saw using the long option finder would give us the highest return. Well, on the searches on power options, whether it be our default searches such as the Bollinger Bands or initial values, or some of our sample searches in the long call strategy, calls to buy, option volume, we typically see options that are just in the money to just out of the money, or maybe a delta of, say, 0.45 to 0.65 in those results. Why those deltas in our searches? Well, we saw how expectations can change the strike price and change the delta of option to give you the best bang for the buck in that previous discussion. And what is a general expectation of a stock move for, say, 20 to 30 days? In general, in normal market conditions, we're expecting a movement of about 2 to 5%. Let's stick with Apple. Currently, it's trading at 148.15, hasn't moved back up from that little decline we saw last week. A 3.5% gain, somewhere between that 2 and 5% expected gain, would be an increase of $5.18. This would make our target $153.33 in about 30 days. Now, this is not a recommendation or a projection of what Apple is going to do. It's just for the example. Using that long option finder, we'd take Apple, we'd put in our stock price of 153.33, 3.5% gain, put about $1,000 into long calls, and we'll go 30 days out roughly to October 14th. What does the long option finder show us? What we see the options that would give us the most profit with a 3.5% movement in 30 days would be options that are slightly in the money. 145 strike with a stock at 148, 140 call, 143, 142, 141, and so forth. The deltas for the 15th of October, the top two positions that would give us the best bang for the buck, are between 0.64 to 0.81, in the money. And for the 22nd of October, we're seeing deltas of 0.59 to 0.74, slightly in the money to even deeper in the money as well. And that's what we'd expect with only a 3.5% move, and we're seeing returns around 33% to 45% on the leverage call position if the stock hit our target around our expected target date. A little bit more, a bigger move. What about a 5% gain? This would be an increase of $7.40, so our target price would be $155.55 in roughly 30 days. Same inputs, $1,000 investment amount, new expected stock price of $155.55 for the 5% increase, and our expected target date of October 14th. What do we see in this situation? Now we start to see still slightly some in-the-money options, the 147, 146, maybe even say the 148 right at the money, and the 145, but we also see out-of-the-money options. The 150 strikes start to appear. Now the deltas for the 15th of October series, if the stock hit our target price on October 14th, are a little bit different. Now we're 0.44 to 0.64. We're not as deep in the money to see the options that would give us the best bang for the buck. Going out to October 22nd, it's about the same, 0.45 to 0.63. So we're slightly in the money, slightly out of the money, right at the money essentially, with a 5% increase to see the returns that would give us the best bang for the buck. And as we saw in the last webinar, a larger move of 10% would be a gain of about 15 points on Apple. This would push it up to 163. The inputs for the long option finder stay the same. Expected price of 163.15, that 15-point movement. Now the best results and the best bang for the buck are all out of the money. 155 on a stock trading at 148, 160, 150, 165 even creeps in there. The 15th of October's deltas range from 0.44 to 0.14, a 14 delta deep out of the money with that 165 strike. And the October 22nds range from 0.49, right at the money, to 0.08. deep out of the money. This is just to illustrate James's question, of course, is there a proper delta to buy? Well, that is going to depend on your expectation, which one's going to give you the best bang for your buck. What about the lowest range, or less of an expectation? Just a 1 to 1.5% movement in 30 days. No, 1% up would be a gain of $1.48 on Apple. That would push us up to 149.63. And we take a look at the results. Everything is out to 2023. September, deep out of the money, 210s, 205s, June 190s, March 185s, 548 days out in time, but only a return of 5%, 4% on the leverage position. There is nothing near term. There's no profit. Why are we not seeing any profit for the at the money, even in the money, or out of the money calls for Apple if it moves up 1 to 1.5% in the next 30 days? And that's because the time value of those options is higher than 1%. We're going to lose all of that, and it's not going to be countered by the gain in the stock. It'd be better in this case maybe to consider another strategy if you have an expectation that Apple's going to stay around 148 or move up slightly. So, is there a proper delta to buy a call? Well, again, we take a look at the expected move, and we take a look at the results and the delta range that we saw. If we expect that 3 to 3.5% move, the results are all in the money. Lower time value to start out with, higher intrinsic value, deltas of 0.59 to 0.81. And with a 3 to 3.5% movement, the highest returns would be the in-the-money calls, with those higher deltas, 45 to 33% return. Reasonable movement, reasonable profit expectation on a leveraged call. We'd like more, of course, but that's reasonable. 5% movement in the underlying security, you're going to be slightly in the money to slightly out of the money, really just at the money. We saw the most profit at a tight delta range of 0.44 to 0.61. Expected return, 86 to 66% if we saw that 5% movement with those options right around the current stock price. That's the target return we want to look for maybe a 20 to 30 day period using a leverage position. But it's dependent on a 5% movement in the underlying, which is usually the upper end of what we would expect in normal market conditions. Stock exceeds your expectations, or you're very speculative, you're expecting a 10% movement in the underlying security in the next 20 to 30 days, you are going to be looking at more of the out-of-the-money options. They're going to give you the highest return. Delta range of 0.49, let's just call it 0.5 to 0.08. And we saw the 504 to 245% returns with the near-term options. But again, that's a large expectation. You have to be very careful about proper position size with these cheaper out-of-the-money options. We would only be allocating $1,000, and that should really only represent maybe 2, 3, 4% of our total portfolio, because if we're wrong, and we're buying those out-of-the-money options and the stock does not see that 5 or 7 or 10% move, we could lose 100% of what we invested into that option. And again, if you only expect a small move, 1 to 1.5%, the next 20 to 30 days, we only saw extremely deep out-of-the-money options, 700, 500 days out in time. Deltas were 0.33 or lower for those options. The expected return was only 4 or 5% on those deep out-of-the-money, far out in time positions with a 1% movement. If that's what you expected for Apple, you'd be better off maybe just trading a bull put credit spread for a 10, 15, 20% leverage return, maybe a bull call debit spread in that case. Now, this is based solely on Apple as an example. The stock is trading at $148. The 50-day volatility is at 0.20 or 20%. The range of implied volatilities we saw in the output from the long option finder are 0.2189 to 0.27. Stocks with a higher volatility, 50-day or 20-day, and higher IV options may have other ranges. But in general, if you're expecting an average movement of 3 to 5%, you're going to be looking in to at the money. And if you're expecting something between 5 and 10% movement, even if it's 60 days out in time, you're going to be looking more at to out of the money in those situations. And that's why it's great to have the long option finder, because you can see directly which calls would give you the best bang for your buck based on your expectation of the stock going forward. Now remember, this is not a recommendation or suggestion to buy calls on Apple or where Apple is going to be trading in the next 20, 30 days. Anytime you're buying calls or puts, using the long option finder tool to see which option will give you the best bang for the buck, remember that changes in implied volatility, especially around earnings season, are going to result in lower returns or a change in returns that aren't going to match the goals you might have expected because the IV might collapse and you're not going to see the value later on in time that you would expect if the stock stayed the same price. Now for the default searches and the sample searches on power options, in general, we see the same thing. To follow up again with James's question, which is the best or proper delta to buy for a long call? Well, if we're expecting normal market conditions, the default searches, the Bollinger Band breakouts, are looking for at to out of the money call options. Deltas of 0.49 to maybe 0.44 or to maybe 0.4. Because it's looking for stocks with an expected breakout on those positions, an expected breakout from the Bollinger Bands, we're expecting a decent movement over time. So hopefully that would go higher in that case. We'd see that 5 to 7% movement where we'd want to be at to out of the money. The initial values default search is more gauged on higher option volume, stock fundamentals, stock trends, looking for further out options for sort of a stock replacement on a growth stock. This is at to in the money because we're still expecting maybe a 5 or 6 or 7% growth, but we're looking further out in time and we're expecting that growth to be longer term, maybe not in the next 20 to 15 days, maybe the next 30, 40 to 50 days out in time. Our default sample searches. In the sample searches section, there's one for current option volume. That's looking at out of the money and in the money call options. No more than 2 strikes in the money, no more than 2 strikes out of the money. This is more based on looking for breakouts based on volume and the hot trending option plays. So both out of the money, in the money, because you could see a large movement, but if you're not as bullish on the stock, once you start to research it from that sample search, you might want to stay in the money, which would give you a good profit if you just saw that 3, 4, 5% movement. The Bollinger Band breakout is very similar to the Bollinger Band default search. It's looking at to out of the money options with an expectation, again, of after the breakout seeing potentially maybe a 5 to 7% continued increase in the stock, maybe after a little bit of pullback, but 20 to 30 days from now, that's what we'd expect to see. That's what we're hoping to see. So we're looking for those more out of the monies, deltas of 0.4 to 0.6 along those lines. The calls to buy default screen is deeper in the money. It's not using a range in or out of the money, but it's looking at deltas of 0.5 to 0.8. Again, because similar to the initial values, it's looking more for stocks that are gradual growth, but still an expected good, normal market, high quality stock, where on average we expect to see 3 to 5% maybe increase every 20 to 30 days in the right market conditions. So as we saw with the screen, if we're expecting that 3 to 5% gain on a regular basis, or during that time frame we're bullish on the market, we would want to be slightly deeper in the money, deltas 0.5 to 0.8 for the ones that have the best bang for the buck.